Howdy, everybody. Welcome to Liberty Call. Today is Monday, December 9th, 2024. Hope you're having a great day out there. Hope you had a good weekend. It's snowing here today. Not heavy, but, enough to make a mess, and I'll have to probably clear it tomorrow morning or tomorrow afternoon. So, yay, exciting. So, anyways, like I said, hope you had a great weekend, and mine's been tapering off some medicine, and it doesn't make me feel very good. So, anyways, but other than that, life is good. So before we jump into some numbers, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. Alrighty, let's get to the Dow Jones. It was down 0.54%, 240 points, closed at 44,401. S&P 500 down 0.59%, 35 points, closed at 6054. NASDAQ down 0.6%, 118 points, closed at 19,741. The VIX was up 10.18% today. It's at 1407. Canada down 0.26, Brazil up 1.02%, and Mexico up 1.6. In Europe, Germany was down 0.15, the UK up 0.52, then France up 0.72, the Netherlands up 0.34, that's Spain down 0.5%, Italy down 0.55, Switzerland down 0.24, and Portugal up 0.29. Russian exchanges in the green today. The MOX up 1.39, RTSI up 1.43%, and the overnights, the Nikkei was up 0.22, Australia up 0.02, so flat. New Zealand, when it closed on the 8th, was up 0.36. Let's see here. The Shanghai in China was down 0.05. Shenzhen Component down 0.55. China A50 up 0.03. DJ Shanghai down 0.22. Hang Seng up 2.76%. And the Taiwan weighted up 0.34. All right. So those are today's markets. Pretty exciting stuff, I know. Let's get to the weekly economic update. Stocks were mixed during the first trading week of December. Technology stocks led while widely followed Dow Jones Industrial Average struggled. The tech-heavy NASDAQ composite picked up 3.34%, while the Dow lost 0.6%, the S&P 500 added 0.96%, and overseas markets gained 1.46%. Tech takes charge. The S&P 500 and NASDAQ rallied to start the week, closing at record highs Monday and Tuesday. The Dow fell on both days. During a conference speech, Fed Governor Christopher Waller said he supports a rate adjustment in December for now, which seemed to add momentum to the S&P's and NASDAQ's gains. Tech shares continue to propel stock gains midweek on the strength of few better than expected Q3 reports. On Friday, the S&P 500 and NASDAQ hit new record highs following the November jobs report. Both notched their third consecutive winning week. By contrast, the Dow was down 4 of the 5 trading days, ending the week in the red after 2 back-to-back weekly gains. All right. Jobs rebound after 2 hurricanes and an aircraft maker strike weighed on the labor market in October. The November jobs report released Friday gave investors what they were looking for: confirmation that the October update was an anomaly. While November payrolls topped expectations, investors believed the hotter than expected report would not influence the Fed's upcoming decision regarding short-term interest rates. The Fed's scheduled 2-day meeting ends on December 18th, which is next week. All right, key economic data coming out this week. Tuesday is productivity and costs. Wednesday is consumer price index and the 10-year Treasury note auction and the Treasury statement. Thursday, weekly jobless claims, producer price index, and the Fed balance sheet. And Friday is import and export prices. Companies reporting earnings this week. Monday is Oracle, Tuesday AutoZone, Wednesday Adobe, Thursday Broadcom, and Costco. All right, so that's the weekly update. Let's hop into the market recap. U.S. stocks drift lower ahead of key inflation release. All right, U.S. stocks slipped Monday as investors turned their focus to the upcoming November Consumer Price Index report, expected to provide key insights into inflation and influence the Federal Reserve's interest rate decision next week. The CPI set to release on Wednesday is forecast to show a 2.7% year-over-year increase with a 0.2% monthly rise. Core CPI, excluding food and energy, is expected to remain well above the Fed's 2% target. Rising food and energy costs are anticipated to be the primary drivers of inflation, according to Goldman Sachs. While the Fed is widely expected to cut interest rates by 25 basis points at its upcoming meeting, the central bank may slow the pace of rate reductions in 2025 due to persistent inflation and a strong labor market. November's jobs data showed higher than expected payroll growth, but weak manufacturing employment, and a declining labor force participation rate, signaling a still mixed labor market. And in corporate developments, Macy's shares gained nearly 2% after activist investor Barrington Capital urged the company to explore real estate strategies and divestment options for Bloomingdale's and Blue Mercury. Hershey jumped over 13% following reports of a potential takeover by Mondelez. I never heard of them. And chip stocks, NVIDIA fell 2.3% after China opened an anti-monopoly investigation, likely in retaliation against U.S. chip export restrictions. Advanced Micro Devices dropped after Bank of America downgraded the stock due to competitive risks. And the earnings outlook. With earnings season winding down, Oracle's results expected after Monday's close will provide additional market insights. And looking ahead, investors remain cautious with inflation data likely to determine the Fed's near-term monetary policy trajectory and the market's broader direction. All right, so that's that. Got our next article here. Comes from Zero Hedge. Household expectations for improving financial conditions surged to a 5-year high after the Trump election. Let's see if they tell us why. All right. The New York Fed's November survey of consumer expectations revealed a slight increase in inflation expectations across all time horizons. Consumers now anticipate price growth of 3% in 1 year, up from 2.9, 2.6 in 3 years, up from 2.5, and 2.9 in 5 years, up from 2.8. Despite these increases, the survey highlighted a significant boost in household financial optimism attributed to the recent election of Donald Trump. Inflation expectations driven by rising food and energy prices. The November CPI expected this week is forecast to show headline inflation at 2.7% year over year, and core inflation to remain well above the Fed's 2% target. Household sentiment. Optimism surged with 38% of households expecting their financial situation to improve in the next year, the highest level since early of 2020. Conversely, those anticipating a worse outlook fell to their lowest since May of 21. And the labor market. Median 1 year ahead earnings growth expectations rose to 3%, led by workers without college degrees. Unemployment concerns ticked up slightly, while the perceived likelihood of finding a job decreased. Spending and credit expectations. Spending growth. The median household spending growth expectations dropped to 4.7%, the lowest since April of 21, but still above pre-pandemic levels. Debt and credit. The probability of missing a minimum debt payment declined to 13.2%, while perceptions of future credit access improved. Expectations for government debt growth fell sharply to 6.2%, the lowest since February of 2020. And the market outlook. Households remain optimistic about equities with a 1.3 percentage point rise in the perceived probability of higher stock prices. Improved financial statement and stable income growth signal cautious optimism even as inflationary pressures and labor market uncertainties persist. Investors await Wednesday's CPI report for further clarity on the Fed's monetary policy trajectory. All right, so it's kind of a mixed bag. I mean, October's numbers look ugly. The numbers we just reported last week look pretty good. So I guess, averaging those out, they're not as worried about, the consequences of another rate cut. I don't know. I would personally leave it alone, but, inflation's still running really high in my opinion, but what do I know? All right, last up from First Trust, Mr. Brian Westbury's Monday Morning Outlook, Irresponsible and Addictive Deficits. So let's see what Brian had to say here. The U.S. economy has defied recession expectations despite tighter monetary policy, largely due to persistently high federal budget deficits. While these deficits temporarily mask the effects of monetary tightening, they also raise concerns about long-term economic health. The key factors preventing a recession: massive federal deficits which soared to 14.7% and 12.1% of GDP in fiscal year 20 and 21, respectively, have remained elevated. In fiscal year 23 and 24, deficits were 6.2 and 6.4% of GDP, surpassing the 5.9% peak under Reagan in 1983, even without comparable excuses such as high unemployment or war spending. Short-term economic boost. Elevated government spending has supported economic growth, with GDP expanding 3.2% in 2023 and is expected and an expected 2.6% this year in 2024, both above the 20-year trend of 2.1. However, the growth lacks the multipliers predicted by Keynesian theory, reflecting diminishing returns on deficit spending. Monetary tightening versus economic resilience. The Federal Reserve's monetary tightening has slowed M2 money supply growth, typically a precursor of a recession. Yet federal spending has offset much of that economic pain, propping up job creation. Nearly half of new jobs in the past year were in government and healthcare. And the challenges ahead: dependency on deficits. The U.S. must reduce its reliance on deficit spending while avoiding economic disruption. Success hinges on implementing pro-growth policies such as deregulation and tax certainty. Inflation risk: cutting spending could slow growth in the short term. If the Fed responds with looser monetary policy, inflation may reignite, undoing recent progress. And the outlook: while deficits have temporarily cushioned the economy, the transition to sustainable growth requires painful adjustments. Balancing fiscal discipline with productivity gains will determine whether the U.S. can thrive in the long run. All right. So, yes, all this extra spending we've been doing has, helped smooth the bumps out in the road. But at some point that has to stop because, you just can't let the debt continue to accrue. And I know that, it was either earlier this year, I think it was, that the federal debt was the interest was growing at $1 trillion every 100 days. So basically $3 trillion a year that's with the payments we're paying into it. So anyways, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help you get on track. All right. Well, hope everyone has a great evening, and I'll talk to everyone next time. Adios.